of all, thanks Gautam sir for uh, joining this session. So, Gautam Bed, I hope he doesn't need any introduction. But Gautam Bed, he is the founder of Stellar Wealth Partners Private Limited, a SEBI registered research and list firm. He is also the founding creator at Chapter, a curation-based learning platform where he teaches the discipline of investing. So Gautam sir is author of the international bestseller on value investing, The Joys of Compounding, which must be the favorite book of many of our listeners. So previously, he served as portfolio manager at Sumit Global Investment and SEC registered investment advisor based in Salt Lake City, USA. Uh, he is a CFA chart holder and member of CFA Institute. And in 2018 and 19, he was profiled in Morningstar's Learn from the Masters series. So, thank you, Gautam sir, for joining the session and looking forward to have a great session.
Thank you, Mohit.
Yeah, so without wasting any time, so we should first of all I'll brief about today's session. So in the first 30 to 40 minutes, I'll ask questions to Gautam sir about and the topic is variant perceptions in Indian equities. We will discuss about variant perceptions in Indian equities. So, Gautam sir, could you tell us a bit about your portfolio construction, tracking, and rebalancing procedure? So, what do you follow in your investing style?
Sure. So let me talk about the portfolio construction bit first. So I follow a concentrated portfolio approach, and the portfolio on an average comprises of 20 to 30 stocks. The reason for this broad range of 20 to 30 stocks is that in a bull market, as earnings growth expands across sectors, we naturally have a more diversified portfolio because we have more opportunities. And in a bear market, as earnings dry up, there are lesser number of opportunities available. So the portfolio becomes more concentrated during a bear market. The aim is to generate 20 to 25% CAGR for the portfolio over a minimum holding period of 3+ years at any point of time from the current price. And the focus is always on portfolio level returns because investing at the end of the day is a probabilistic activity. So some stocks will do very well, some stocks will go nowhere, some stocks may fall. So, but the focus should always be on the overall portfolio level returns. I follow a sector and market cap agnostic investing approach with a bias towards under researched and well run small to mid cap companies. As far as the allocation aspect is concerned, there is no hard cap. There is no formal hard cap on the contribution to the portfolio from any one single idea or sector or market cap range, but I make sure that prudence is maintained at all times. The weight per stock ranges from 3 to 5% initially, and the exceptional opportunities sometimes get an allocation of up to 10%. The decision to sell any stock is solely based on its underlying business performance or the potential incremental IRR. The decision to sell a stock is not based on macros or overall market or overall indices short term view. It's all bottom up. And a portion of the portfolio is kept in cash if the valuations of existing holdings and the watch list become exorbitant. Now we come to the portfolio tracking aspect. So I track industry trends of my portfolio companies like changes in competitive landscape, technology changes, government regulation changes, any supply chain disruptions. The quarterly results are evaluated for each of the portfolio companies against my own expectation, and the performance is benchmarked against that of competitors. And I carry out a detailed diligence in case any investment's performance is not as per the initial investment hypothesis, even after from a year of purchase. Finally, we come to the portfolio rebalancing aspect. So any investment is exited only if its valuations become absurdly expensive given the growth, or if there is a structural challenge to its business fundamentals. The portfolio companies are periodically ranked based on valuations, earnings performance, expected future stock returns from the current price, and the rebalance is done accordingly. And fresh or follow-on investment and an idea is done only if it can deliver an attractive IRR over a period of the next 3 years. So basically for our small case portfolios, we select companies which can double their earnings over the next 3 to 4 years. So broadly growing their earnings at between 18% and 26% CAGR. So this in a nutshell is the summary of the portfolio construction, tracking and rebalancing process.
Yeah, yeah, it answers the question. So, in current times, like markets are fairly volatile. So, how do you generate ideas? So, while we are betting on the earnings growth, there are many headwinds such as input cost rise. So, how do you handle all these headwinds along with generating ideas for your investment?
Well, that's a good question. And as far as the idea generation process is concerned, it's a very structured process, as should be the case with most investment managers. And every single day, I diligently review all of the corporate announcements on the Bombay Stock Exchange. And it's a painstaking exercise for many, but for me personally, it's like an intellectual treasure hunt wherein I may strike gold anytime. And this way, every day I'm creating numerous opportunities for serendipity and good luck to find me. I review the company press releases, investor presentations, M&A deal, joint venture, partnership agreements. Also, another good source for idea generation is reviewing the quarterly results. Here, I look out for what I call breakout earnings. So, when I say breakout earnings, I'm referring to companies which have reported a year-on-year revenue growth of more than 50 to 100%, earnings per share growth of more than 300 to 400%. In such cases, generally what happens is that the stock market is slightly slow to adjust the stock price to the right higher level. So even if you buy the stock the next day at 5-10% higher rate, you still end up making good returns. This phenomenon is also known as PEAD, or post earnings announcement drift. Another very good source for idea generation is attending the conference calls of the watchlist companies. I go through conference calls on Trendline, Alpha Street, Research Bytes, company website, investor relations section. A peculiar problem with many Indian promoters is that they tend to be overly bullish during good times. So it's very important to corroborate and cross-check what they're saying with what the global peers are saying. What is the commentary and outlook being given by the global peers? Management interviews are another very good source for idea generation. I try to go through all the management interviews available on print and digital media for my portfolio companies and watchlist companies. Another very good source for idea generation is screeners. So Tejuri Finance is very good for tracking chemicals and commodity prices. Screener.in is very popular among investors in India. And I also use a global screening tool called TIKR. That's also a good source for filtering out ideas. When using screening tools, I look for companies which have either completed a very big capex recently or are in the process of completing a very big capex. I also look for stocks which are hitting 52-week highs, all-time highs, or post-IPO new high. Now, let me elaborate a bit quickly on post-IPO new high. Many times you'll see that after the initial listing pop on the listing day, stocks tend to go into a long-term consolidation range for the next 8, 9, 10 months. And when they finally break out after that multi-month consolidation, it generally coincides with some important corporate development taking place in that company. So those are good starting points for further research. And at the same time, it's very, very important to note that time frame matters when you're evaluating price action and generating ideas. In a bull market, when many stocks are hitting 52-week highs regularly, we should look for stocks hitting multi-year highs. Just immediately after a bear market crash, look for stocks hitting a 3-month or a 6-month high. And in a range bound or sideways or non-trading market, you look for stocks breaking out to fresh 52-week highs. So time frame and context is vital when you're evaluating price action. Now, the next source for idea generation which I use is equity research reports. I like the reports being issued by Ambit, ICICI Securities, Spark Capital, India Infoline, Nirmal Bang, and Axis. I also read the annual reports of all my portfolio companies and watchlist companies. And I also try to read as many credit rating reports as possible. Now, note in case of certain micro caps which have loans outstanding or have taken loans in the past, these credit rating reports will often be the only third-party source of information available to you in the absence of any presentations or conference calls. So try to read as many credit rating reports as possible. Draft red herring prospectuses and QIP offering documents are another great, very rich source of information on any specific industry. So, for instance, if anyone wants to understand the dynamics and economics of the music licensing industry in India, they can read the recent QIP offering document of Saregama Limited. Not a stock recommendation, but these are generally good sources for building your circle of competence. Investor letters by investors whom you admire and respect are another very good source for idea generation. So I like reading the letters written by Solidarity, Sage One, Equirus. I also try to attend as many investing conclaves as possible. So I like Tamil Nadu Investor Association, India Investing Conclave. SOIC webinars are also a good source for generating some ideas for research. Another very good source for idea generation is that of fund managers' top 5 holdings from PMS Bazaar website. Now, this is a less talked about source, but it's a very good source because the sign up on PMS Bazaar website is free, and once you have logged in, then you can check the top 5 holdings along with their weightages for many PMS fund managers.
Yes, so I have a counter question. So, are there any sectors which you avoid? So, while you say that you look for breakout earnings, so which are the sectors which you avoid? Because sectors such as metal and real estate will have a quarter of exponential growth, but then those earnings are not sustainable. So, are there any sectors which you avoid?
Well, in the market, I think we should never say never. And any sector, like I think metals were the most hated sector for 10 years. But over the last 1.5 years, they've been among the best performing sector. It's every sector has its day in the sun in the stock market. So we should always have an open mind. And these places like cyclicals, metals, real estate, they are very deep. Real estate and metals in particular, they are deeply cyclical. So they are in deep cyclical sectors. Their cycles last very long, both on the downside and the upside. So it all depends on which part of the cycle you are. I think the best time to buy these into these kind of deep cyclicals is when the industry is undergoing a downturn, and there is a lot of consolidation happening. A lot of smaller are going bankrupt, and capacity is getting reduced. I think that is the best time to enter into such opportunities. So it all depends on what kind of value you can derive and your time horizon as well, because these industries require a lot of patience. If you enter them during the down cycle, then it requires a lot of patience to reap the big rewards. I'll share a personal example here. So during 2018 and 2019, the Indian auto industry was in a down cycle after the NBFC crisis, and there was an auto ancillary company named Rajratan Global, which was undergoing a very big capacity expansion program. Because the entire auto sector was out of favor, investors' attention on this particular stock was very low. So one could accumulate as much quantity as he or she wanted. And once the earnings visibility went up post completion of the capex and the revival in the auto industry, after April 2020, the stock of Rajratan Global has given more than 1000% returns in the last 1.5 years. So one requires this capital cycle approach of investing requires a contrarian mindset and lots of patience, but it's highly rewarding.
Great. So, Gautam sir, you have often referred to the importance of focusing on process as an investor. So, could you please elaborate on that?
Yes. So, if you look at the key attribute of all the great investors in the world, it is a relentless focus on the underlying process, and the reason for this is numerous research studies have identified a common trait among successful professionals in fields of probabilistic activity. They all emphasize process over outcome. If you focus only on the outcome, you are less likely to achieve it. Instead, if you focus on adhering to a sound process, the outcome will take care of itself in the long term, although the short term results will almost be driven by luck. Over the long run, a sound process can be counted on to deliver desirable results in a sustained manner and produce more reliable outcomes. And this greatly applies to the field of investing, because at the end of the day, investing is a probabilistic activity, which means even when we follow a sound process, sometimes because of bad luck, we'll get a bad outcome. And sometimes, in spite of following a bad process, we'll still end up with a good outcome driven by good luck. But over the very long term, skill is what eventually wins out. And Over the long run, a sound process is what leads to more reliable outcomes. Michael Mauboussin has spent some gems on this topic in the past. Let me quote him. In a probabilistic environment, you are better served by focusing on the process by which you make a decision than on the outcome. We have no control over outcomes, but we can control the process. Of course, outcomes matter, but by focusing our attention on process, we maximize our chances of good outcomes. This is what the good investors or any professional in any field of probabilistic activity focuses on, the underlying process.
Perfectly said, Gautam sir. So, in the last question, we discuss about how do you generate ideas for your investment. So we can research on a particular company. We can go through the annual reports. We can read the management discussion and analysis report
Mhm.
where they also provide their statements. But how do you evaluate management quality without meeting them? In most of the small cap and mid cap names, because most of them even don't organize con calls. So how can we evaluate management quality in that case?
Very good question, and this is a common question which I keep getting. Well, being based out of the US, how do I evaluate management quality of companies in India without meeting them? It is done by following a comprehensive corporate governance checklist. So I follow a very rigorous diligence process to avoid the big losses and to avoid errors of commission. I look for any frequent change in auditors, any qualifications raised by auditors. Are the auditors earning any abnormal fees? Is the auditor fees growing faster than revenue growth? Does the company have a large number of unaudited foreign subsidiaries? Does the promoter have any political affiliations? Does he have any criminal proceedings against him? Has there been any CBI enforcement directorate or IT raid on the company? Has there been any history of SEBI debarment? Is there any history of mass exits in the top management suite? Is the key management personnel drawing excessive remuneration or blowing large sums on a lavish corporate office? Like, Adam, without naming names, just recently a pharma company which was just beginning to turn around, they blew 200 crores of shareholder money on a corporate office. I mean, just when conviction was building on that company, these guys blew hundreds of crores of shareholder money on building a lavish corporate office. So you ideally want to look for managements which are much very frugal in nature and respect shareholders equity and treat every bit of equity like gold and do not just waste money of the shareholders. I also check for history of equity dilution by the company. Is the promoter holding coming down over time? Has the promoter pledged his shares? What is the history of the company sharing its wealth with minority shareholders in the form of dividends and share buybacks? What are the credit rating reports saying about the company? Are there any related party transactions taking place in the company which are very big and significant? What is the view of the current and ex-employees of the company? You can get this information on websites like Glassdoor. What are the industry experts saying about the company? What are the reputed investors whom you like and admire saying about the company? Does the promoter have any similar business as the listed entity in his private company? Because there may be a conflict of interest there. Also, evaluate the accounting quality. For example, check if there is any volatility in the depreciation rate, because the depreciation rate can be modified by the management to manipulate earnings. Check if the expenses have been written off directly against reserves and surpluses from the balance sheet instead of being routed through the profit and loss statement, thus inflating profit. Check the revenue recognition policy of the company. Are they following conservative or aggressive revenue recognition policy? Is the business very working capital intensive? Is there a increasing accounts receivable days pattern? Because if the accounts receivable days are going up, that means sales are not being converted into cash flow. Check for the historical trends in cash flow from operations to net profit ratio, the historical cash flow from operations to EBITDA ratio. Also check if the company in a commodity industry is earning abnormally high margins compared to its peers. It's very unlikely that your commodity peers are earning 10% margins and you're earning 30% EBITDA margins in a commodity industry. In those cases, you should do a deep dive into why this is happening. Also check for any excessive write-offs of assets in the past by the company. Also check whether the company is capitalizing its operating expenses. A good example here is the Indian pharma industry. R&D is a very common line expense item, but some managements try to smooth out the earnings by capitalizing R&D, whereas the other conservative managements, they expense the full R&D cost in the P&L in the year it is incurred. Check for trends in the debt to equity ratio. Check if the company has defaulted on any statutory payments in the past. Does the company have a very high a large number of contingent liabilities, and there can be certain cases in which the promoter has given a guarantee on the on the unlisted group company's debt through the listed entity. So all this information basically is available in the annual report, and doing a deep dive into the annual report, the footnotes to the accounts can actually help you avoid a lot of landmines in the Indian market. I think, in fact, following this corporate governance checklist has helped me avoid questionable managements and stocks for my small case portfolios as well. And it's very easy to get carried away in a bull market because these managements come on business television, give very bullish commentary, and everything looks very hunky dory and rosy. But it's always, but based on my past experience, I've seen that whenever the subsequent bear market comes, these are the very stocks which tend to get punished the most. And a bear market clearly, very strongly differentiates between good management and bad managements. And in the long run, the paper profit which you make in a bull market will hardly mean anything unless you're able to preserve it over the long term. And in those cases, it's the quality of the management which will help you preserve that wealth.
Yeah, correctly said, Gautam sir. So there is a very old saying that you should bet on the jockey and not on the horse. So we should always know who is running the company in which we are investing. So Gautam sir, you have talked about behavioral edge as being the most durable edge for investors today. So can you please talk a bit more about this?
So, Mohit, traditionally there have been three sources of edge for the individual investor. The first source has traditionally been the informational edge, like what used to exist during the early days of the Buffett partnerships in the 1950s and 1960s. That time you could simply get an edge over others by flipping over more rocks and just going through the Moody's manual and more publicly available information. But with the advent of the internet, the information edge is basically gone. The second source of edge for the investors traditionally has been the analytical edge, or being able to analyze a business better than your competition. But with more and more smart people entering the investing profession, even the analytical edge is fast getting compressed. But the one edge, which in my view is the most durable and sustainable and permanent, is that of behavior and temperament. Shane Parrish of Farnham Street blog had once written, and let me quote him: "People who arbitrage time will almost always outperform. The first order thought of instant gratification is a crowded path, ensuring mediocre results at best. Delayed gratification, which requires second order thinking, is less crowded and more likely to get results." In a similar vein, Howard Marks has said, and I quote, "Rule number one, most things will prove to be cyclical. And rule number two, some of the greatest opportunities for gain and loss come when other people forget rule number one." I've talked about this particular behavioral and the importance of the behavioral edge in my book as well. Let me quote from my book as well. 50 years ago, the best investors were the ones with an informational edge. Today, the best investors are the ones with a behavioral edge. As the speed of information dissemination in the markets and competition for short-term outperformance among money managers increased over the years, time horizons and patience levels significantly decreased. Today, an investor's edge is less about knowing more than others about a specific stock and more about the mindset and discipline and willingness to take a long-term view about the intrinsic value of a business. So this is basically a summary of the significance and the importance of the behavioral edge.
Yeah, very well said, Gautam sir. So, you have dedicated an entire chapter in your book to pattern recognition. So, what is it, and could you please share some of those patterns with us, along with some case studies?
Sure. So, successful investing is all about pattern recognition. So much so that I've devoted an entire chapter titled Pattern Recognition in my book, in which I've shared the various catalysts for re-rating through the use of management and market signals. And let me share a few of them with all of you. Along with the slow and gradual macro changes, investors should also be alert to tiny changes at the micro level. Be alert to tiny changes like the declaration of a maiden dividend, receipt of a large order or a landmark contract, appointment of a Big Four auditor, increased or first-time disclosures or discussion about business prospects and future plans in annual reports, presentations or press releases, a chairman or a chief executive of a listed company sharing business commentary for the first time, a company holding an analyst or investor conference call for the first time or after a long time of many years, an upgrade of a company's debt instruments by the rating agencies, a sudden increase in the market value of a company's bonds, because bonds are more sensitive than stocks to changes in the economic fortunes of a company, or notable improvements or deteriorations in the working capital cycle of a company, always monitor the direction of the quality of earnings. And such an elaborate and exhaustive exercise requires total dedication on part of the investor, but it is highly rewarding. So let me share a case study from using one of these patterns. So I talked, one of the patterns which I just shared was increased or first time disclosures or discussion about business prospects and future plans in annual reports, presentations, or press releases. So just a few months ago, on 1st November, a company, this is just an example for educational purposes, not a stock recommendation, but on 1st November 2021, a microcap named Natural Capsules came out with the investor presentation for the first ever time in its listed history, in which they outlined their capex plans and the expected asset turnover on the new capex. So they're going to do a capex of almost 100 crores, and they are expecting a 3x asset turnover, which means they'll get 300 crores of additional revenue from this new capex, and this new capex will come on stream in Q2 of FY23. So, and the trailing 12-month sales of Natural Capsules was just 100 crores, which means that this company is talking about quadrupling its sales within less than 2 years. So ever since the date of that investor presentation on 1st November, the stock price of Natural Capsules has gone up more than 150%. In just 2 months, you could have made 150% just by following this particular pattern of first ever investor presentation by a company. Another pattern which I talked about was that of always monitoring the direction of the quality of earnings, because in investing, it's all about delta, or the rate of change in earnings growth and its underlying quality. And Warren Buffett has talked about this in the past when he said, a business should be viewed as an unfolding movie, not as a still photograph. So there is a century-old company in India. It's again just for educational purposes. This company's name is Dharamsi Moraji Chemicals. From 1919 to 2005, they were in the fertilizer business. In 2005, they shut down the fertilizer business and started the manufacturing of low-margin bulk chemicals. And from 2011 onwards, they started focusing on high-margin specialty chemicals business segment. And just last year in February, they came out with a detailed investor presentation on the Bombay Stock Exchange, in which they outlined their capex program. And as soon as the earnings visibility of the company went up among the investor community and the direction of the earnings quality improved, because the company is now focusing on higher margin specialty chemicals business. So since then, the stock of Dharamsi Moraji Chemicals, or DMCC, has given more than 40% returns till date. So it's very important to understand the direction in which the earnings are going. The underlying quality is basically what the market really cares about. Another important pattern which I discussed was that of receipt of a landmark contract. So here again, let's look at a case study from the Indian stock market. In February 2020, Navin Fluorine won a 2,900 crore 10-year contract in its high performance product segment. And since February 2020 till now, the stock of Navin Fluorine has gone up 150%. Now, it's very interesting to note that out of the 150% stock price returns of Navin Fluorine since February 2020, 100% out of that 150% return has come from PE re-rating. So the PE of Navin Fluorine in February 2020 was 40 on a trailing basis. Today it stands at around 80 on a trailing basis. So the PE ratio basically has doubled from 40 to 80. And in order to understand why this happened, why did the PE ratio basically double for Navin Fluorine, we need to understand the art of valuation. To be a successful investor, you don't need to do a precise DCF calculation. You just need to have a DCF mindset, focusing on the drivers of terminal value. Terminal value is everything in investing. That is what drives multiple re-rating and de-rating. The reason, we have to understand the reason why the P ratio doubled. The reason is that the risk perception of the cash flows of a company among the investor community drives the discount rate, and that discount rate in turn drives the valuation of the company. Markets provide disproportionate rewards to companies that can promise years of sustainable earnings growth. And the market places a very heavy weight on certainty. That's why you'll see stocks with the promise of years of predictable earnings growth tend to go into a long period of overvaluation until such time that they are no longer able to grow earnings in a steady manner. Predictability of long-term growth matters much more to the market than the absolute rate of near-term growth. So a stock that promises to grow earnings at 50% or more for the next few years with no clarity thereafter, that is given a lower valuation multiple by the market than a stock which has got slower but highly predictable growth for a much longer period. Consistent growth increases valuation, and consistent disruption decreases valuation. And how the longevity of growth is always given a greater weight by the market than the absolute rate of growth. So you will often observe stocks with 12 to 15% predictable earnings growth for the next 10 to 15 years, getting current year P multiples of 40 times to 50 times. And this phenomena perplexes many new investors, but with experience, they come to appreciate the finer nuances of the market and respect its wisdom. I want to highlight that it is the risk perception of the cash flows which drives the discount rate, and that in turn drives the valuation multiple. I'll give you two examples. I'll discuss two examples here from the Indian market. So there's a pharma company, no recommendation. There's a pharma company called Solara Active Pharmaceuticals. Now it's given a low valuation multiple because a large part of the business is driven by the volatile ibuprofen commodity business, right? But now the company is focusing on increasing the share of CRAMS in its overall business mix. So what's going to happen over time? Over time, as the once the share of CRAMS in the overall revenue mix goes up a lot, then the risk perception of cash flows of the company will go down. The discount rate will go down for valuing the company's cash flows, and the valuation multiple will go up. We don't have any exposure to Solara in our small case portfolios or proprietary accounts. This is just to illustrate that the real risk, when I say risk, that risk perception is what drives the discount rate. The real risk lies in volatility of cash flows. That is what we have to focus on. And one more good example here is recently Saregama completed a 750 crore QIP. And once the stock price of Saregama had already re-rated a lot, but once the management mentioned that they'll use the entire proceeds from the QIP into the highly lucrative music licensing segment and not the loss-making Carvaan and film production segment, the stock of Saregama got further re-rated because the risk perception of the cash flows associated with the company went down. So the discount rate used by the investor community went down and the valuation multiple again went up. So it's all about the risk perception of the cash flows, and if you can understand where the trajectory is going, then you can catch the multiple re-rating. That multiple re-rating is a key component of all the big multi-baggers for investors. So if you can understand what is driving this multiple re-rating or de-rating, you can earn very outsized returns in the market.
Yeah, so Gautam sir, coming back to your investing process, so how has your investment philosophy evolved over the years? And one more question. All of us discuss about how do we enter in any particular stock, how do we identify any particular sector, but what is the best time to exit that stock or investment?
So let me answer the second question first. That's more straightforward. So everything is a function of opportunity cost. If you come across an alternative opportunity which offers significantly higher returns than any of your existing portfolio holdings, then it's a good time to switch. Another good time to switch is when you experience a big corporate governance issue. This is a key. So in India, I've observed over the last 15 years, more than business risk and valuation risk, the big or even the regulatory risk, the biggest risk in India is that of promoter risk. Just I was reviewing a particular development in one of our small case model portfolios today, and there seems to be a corporate governance lapse in one of the companies, and I think it's time to this is a good example of the time for a rebalance. Basically, when in doubt regarding corporate governance, you should ideally get out, because the moment the market gets a whiff of any corporate governance lapse or any serious corporate governance issue, it's very ruthless. So we saw what happened with HGS just a few days ago. The market was expecting a very big special dividend, but that did not come about. In fact, the promoters increased the amount of loans they can give to promoter entities, and the stock just hit 20% limit down straight away. No, again, not a stock recommendation, just for educational purposes. But it's very, the moment you start feeling uncomfortable with the corporate governance practices of any company, it's best to just get out. In a bull market, those stocks may go up even further, but over the long run, those sins of the management will eventually catch up. So it's better to just exit in such cases, in my view. The third and final reason for exiting a stock is when a stock becomes absolutely expensive. Now, what is expensive is basically a very subjective term. The quality here, I would like to emphasize a very important point, which it's a more of a finer nuance, but it's important to get this. The quality of shareholders in a company determines, and their IRR or their discount rate. Basically, the discount rate. What is when I say discount rate used by the shareholders? What am I referring to? The cost of equity is basically the expected rate of return which the investor is expecting, right? So, in a company like DMart, even if it will grow at 20%, because the quality of the shareholders entering the company, many of these foreign investors, when they come in into high quality stocks. When they enter into high quality stocks, they are entering with a very low discount rate. Their discount rate is basically in low single digits, right? The way they value, so for such an investor, for those category of investors, the fair valuation multiple for a DMart or any other business with high longevity, the fair valuation multiple for those investors is very, very high. So they are comfortable paying 100 to 150 P multiple also, because they are using a very low discount rate when they enter these stocks in India. But in case of other investors who are having a very high discount rate, for them the fair valuation multiple will be much, much lower. That is why in the market we see a different set of investors for each stock. Like, we cannot just put blanket statements like DMart is overvalued or this company is overvalued. Overvalued compared to what? It's overvalued only calculated or based on the calculation using our discount rates, right? So there is a different set of investors for each stock in the market. So the quality of shareholders in any company also drives the valuation multiple. So it's very important to keep that in mind. So I've told you the three reasons for for selling a stock. A better opportunity comes, there's a corporate governance lapse, or if the valuations have become absolutely expensive given the growth. I don't want to pay 70 TP multiples for 10-12% growth for these consumer companies. I'm fine with paying even 100 P multiple if I can get 40-50% earnings growth for the next 4-5 years, because over time the P multiple will come down. But I'm not willing to pay high P multiples for low growth. So that's about the selling aspect. As far as my personal investment, how it has evolved over the years. So initially I started with reading Benjamin Graham's Intelligent Investor. So I started with investing in low price to earnings and low price to book stocks. Then I read Buffett, Munger, Phil Fisher. I started investing in secular growth stocks at reasonable to expensive valuations. But today it covers multiple areas of the investment universe, including commodities, cyclicals, deep value, special situations like merger arbitrage and demergers, and turnarounds. Instead of being restricted by my personal biased views to a small opportunity set, as was the case during my early years, I am now able to invest in a variety of industries and situations wherever I find mispricing of value and a highly favorable risk and return trade-off. You see, no single strategy works all of the time and in every kind of market. And that is why it is essential to build up one's investing arsenal to be able to hunt for value from within different areas. And over the years, I've come to realize and appreciate just why this is so critically important. It is because a bull market is always going on at all points of time in some specific sectors of the Indian stock market. Between 96 to 2000, it was in technology, media and communications. Between 2003 to 2008, it was in infrastructure, commodities, real estate, organized retail. Between 2009 and 2014, it was in discretionary consumption, pharmaceuticals, IT services, FMCG. And between 2015 to 2018, it was in autos, specialty chemicals, and financials like NBFCs and microfinance companies. And since April 2020, a bull market has started in multiple sectors in India. For example, the import substitution theme and various subsegments within India's manufacturing industry are doing very well. CDMOs are doing well. CRAMS is doing well. Residential real estate has recovered after a decade. So building materials and housing finance companies are doing well. The Indian government is placing a heavy emphasis on ethanol blending. So distillery companies are doing well. Then, because of COVID-19, digital transformation and various subsegments within IT services are doing very well. Cloud computing is in a long-term uptrend. Even the electric vehicles is a big theme within auto. So, between during every cycle, catching the cycle early is the key to alpha generation. And we have to just keep on evolving and learning along the way and keep expanding our circle of competence to be able to participate.
Yeah, even I concur with your views that about the second question first. On the corporate governance front, and if the valuations are expensive, then you should probably think of exiting that stock if you find better opportunity. And an investor should be flexible. So these are two key points which we learned from your statement. So, Gautam sir, uh, could you share some book recommendations for our audience? And post that, we can move to question and answer session.
Sure. So let me investing books. We all know the classics. Peter Lynch's One Up on Wall Street, Phil Fisher's Common Stocks and Uncommon Profits, Howard Marks' The Most Important Thing, and Warren Buffett's Partnership Letters and the Berkshire Hathaway Annual Letters. They are a very good source for all investors to brush up on their investing knowledge. And I'll recommend 3 non-investing books as well, which are very good for multidisciplinary thinking. One is Seeking Wisdom by Peter Bevelin. The second book is More Than You Know by Michael Mauboussin. And Poor Charlie's Almanac, edited by Pete Kaufman. So these 3 are very good books for multidisciplinary thinking and broadening our worldview.
Yeah. So we are having more than 1,250 members, and there are already 16 requests. So please ask one question per person because we have some time limitations. So I'll take the first question from Akshay Inamke. Please go ahead. Please ask only one question, and then again you can join the queue. Akshay Inamke, please go ahead.
Hello. Hello.
Yeah,
Okay.
Akshayji, please go.
Gautam sir, India as a whole is going through a major capex. So as many companies from the listed player. So how to play this capex theme and how to find whether the companies are matlab management doesn't siphoning off the funds under the name of capex.
Well, that second part is a bit more tricky to answer, but the easy way to play capex is through a lot of. So, as you must be knowing, Kumar Mangalam Birla recently talked about a capex Mahotsav in India over the next decade. One indirect way to play capex is through good quality lenders, because no capex cycle in history has ever taken place without the financials doing very, very well. When I'm referring to the lending businesses here, that's one way of playing the capex cycle through financials. You can also look at select pockets within capital goods. I would be wary of infrastructure, but select pockets in capital goods do look very promising, and I'm researching a few of them for our FlexiCap small case. I think a few of them have got pretty good balance sheets, and they have shared wealth with the shareholders in the past through dividends and buybacks, and they've done all their capacity expansion through internal accruals. So all the hygiene checks are in place. So you can look at select pockets within capital goods as well as lenders within financials if you want to play the capex upcycle.
Manufacturing sector has also been on a greater capex. मतलब बहुत ज़्यादा capex हो रहा है manufacturing sector में.
Yes, it is happening. Yes. And I think that is going to be the big key foundation of this particular bull market. So the 2003 to 2007 bull market in India was also largely driven by a big capex cycle. I think we are entering a similar phase now with driven by the PLI scheme in particular. PLI scheme has itself opened up numerous investment opportunities across sectors. You look at the PLI amount for auto ancillaries and textiles and other industries. I mean, there's a plethora of opportunities. Just look at the amount of capex, the size of the capex, and by the companies across industries, which is happening. This is kind of unprecedented in the last 10 years. I have personally never seen this level of capex capacity. The amount of money which companies are spending, it is just going to lead to a very big surge in earnings growth across sectors, and that is why I think this bull market, it'll have its intermittent sharp corrections from time to time, but I think the next 4-5 years are looking very, very promising.
Yes, sir. Welcome, sir.
Akshay ji, please one
Yes.
question per person.
Thank you.
Amit ji, please go ahead.
Yes. Hi, Gautam. Excellent presentation. Some great insights. I have been disconnected a few times and I've reconnected, so I don't know if you've covered this. But just a very quick question. What do you consider as exorbitantly expensive in terms of valuations? Just to give you an example, DMart has always looked expensive in terms of PE multiples, also in terms of, the PEG ratio. So, and many people have sold out earlier, just given the valuations, and the stock has gone on to become even more expensive. So how do you handle something like this, that you don't get out too early? Yes.
I talked about this valuation part just short while ago, that ultimately the valuation multiple with which you are comfortable is a function of the discount rate which you're using. That discount rate which you are using in your personal context is driven by your return expectations. In case of foreign, many FIs who enter these stocks with a very low discount rate, for them the fair valuation multiple is more than 100 to 150 PE also, because they're entering with 2-3% discount rate and they're applying to to a very high longevity of growth. So for them, the fair valuation multiple will come to a far higher number than in our case. But when I say exorbitantly expensive, it's all context dependent. It depends a lot on what kind of growth I'm expecting from that company. So there is a specialty chemicals company in our FlexiCap small case, it trades at a trailing P of 100 times. But the longevity of growth in for that particular company and the amount of capex which has just come on stream ensures a very high earnings growth for the next 4-5 years. So I'm comfortable, even with that high valuation multiple for now. But the moment this growth starts slowing down, I will exit. So, and also a good way to optimize your exits in certain scripts is, and these kind of scripts is, if you have entered a company which has just completed a very big capacity expansion, and once the company has fully utilized its big expanded capacity and the market has re-rated stock to from suppose 20 PE to 60-70 PE, but once the capacity has been fully utilized and there is no additional capex coming on stream, then that's a good exit point. Again, you can basically time your exits better. It's all about for how long the high earnings growth can continue.
All right. Okay. Thanks, Gautam.
Yeah, thank you, Amitji. Next question from Mr. Yadu. Please go ahead. You can unmute yourself.
Hello.
Hi, Yadu. How are you?
Yeah, please go ahead.
Hi, Gautam. How are you? Thank you, Mohit and Udit, for giving me this opportunity. Hey, hi, Gautam. It's great to listen to you speak.
Same here, Yadu.
Just brief introduction. I'm an engineer working at Intel here. And Gautam, first of all, congratulations on starting your small cases in India. I believe that's a fantastic opportunity for many retail investors to participate and partake in your own wisdom and journey also. So congratulations.
Thanks, Edu.
Yeah, so I have two small questions, part A, part B. I think Gautam, you'll probably enjoy this. But before, I just want to share something about myself and Gautam. I've known Gautam for about close to 3 years now. 2019 March, I kind of met him, and there are a lot of stories I can share, but probably for a later time. But I just want to share for people who have not read his book. There is a chapter in his book, chapter 18. And in fact, if you haven't read it, I would highly recommend you read it again. And it's the subject is called, the header is Intelligent Investing is all about understanding intrinsic value, where he talks about owner earnings. I believe that chapter is kind of worth its weight in gold. And Gautam already touched a lot of concepts from that chapter in his talk. So please go ahead and read it. Anyway, thank you, Gautam. Let me get to my question. The first question is, the part A is for people, someone who is kind of starting their journey in investing. how do they become somebody like you, or even get to 5% of whatever you have built on your knowledge, right? So process, what is your current process? How can you share that with others so they can learn? And part two is, what do you think is your opinion about the role of journalism to spread awareness on the concept of investing in businesses for long-term growth and compounding, etc., versus what currently is probably seen in Indian retail sector, more of short-termism. So, is there any role journalists can play? Is my question. So, thank you, Gautam.
Gautam sir, you are on mute. Please unmute yourself.
Is my voice audible now?
Yeah.
So let me answer Theru's first question at the very onset, that how can one accelerate the learning curve and become a much better investor in a shorter span of time. I've already talked about the various good investing and non-investing books, but one of my key reasons for starting my chapter on investing, it's titled The Discipline of Investing series. It's basically a 4-week, teach 4-week courses on investing. It's a series of 3 chapters. And through these 3 chapters, I've basically covered every single important aspect of the investing profession. And the idea is to basically curate and provide all the learners with the best and greatest content on the internet on the investing profession. So basically, I've covered almost everything that you can think about: cyclicals, commodities, special situations. What are the long-term drivers of value creation in high-quality businesses? How to build the required temperament and mindset to become a better investor? An extensive masterclass on financial market history over the last 120 years. And also a very basic introduction to investing. So the reason for creating the Discipline of Investing series in my chapter was to accelerate the learning curve, because it's my personal belief that, I mean, in today's times, there's never been a better time to be an investor and a learner. And the opportunities are simply limitless and endless in today's times. I think apart from the books that I mentioned, you should everyone who's just starting out their investing journey should seriously consider the 3 chapters which I've created. It will greatly accelerate your learning curve. So that's the answer to the first part of your question, Yadu. As far as the second part, I think I've talked about the importance of behavior. I think people with a good temperament and who exhibit good behavior have an edge over the short-term minded investors whom you mentioned. In today's times, we are living in the age of instant gratification. So instant noodles, instant coffee, instant everything. Very few people are willing to take a long-term view and invest for the long term. Everyone is thinking about the next week or the next day. If anyone asks you what do you think the market is going to do in the short term, what do you think the Sensex or the Nifty is going to go in the short term, you immediately can understand that person has got a short-term mindset. If you look at the big investors like Rakesh Jhunjhunwala, Ramesh Damani, Ramdev Agarwal, R.K. Damani, all of them simply believed in the power of India and its entrepreneurs, and they all believed in the power of long term. So all of them remained invested in the market through all the ups and downs over the last 30-40 years, and they created big wealth. Do you think Rakesh Jhunjhunwala is going to sell any of his Titan shares if he thinks that the Federal Reserve is going to hike interest rates tomorrow? He won't, right? Because he has got a very long-term view. Once you've found the goose that lays the golden eggs, don't kill the goose. Just stay put. And Charlie Munger has said it very aptly that the first rule of compounding is not to interrupt it unnecessarily. So just stay invested. I'm not advocating just being inside one single stock for the long term. The important thing is to be remain invested inside the market for the long term. You can keep rotating within your portfolio, but don't liquidate your personal portfolio to fund personal expenses. That's very harmful behavior for your long-term wealth creation journey. Just remain invested, and once you have accomplished your financial goals, that is the way to go. Investing should basically, the only benchmark you should care about is whether you're on track to achieve the financial goals you have set up your portfolio to achieve in the first place. That's the only benchmark that matters. What your peers are earning, what the Sensex or Nifty is doing. Now, all of that is just noise. It just a kind of a bias which we create in our minds. We should simply focus on our personal goals and see whether we are on track to achieve them or not. Successful investing is one that lets you sleep peacefully at night. It's all about achieving our goals with the least amount of risk. That's it.
Wonderful. Thank you, Gautam. And for a second, I think I saw Vitali on the call. So Vitali, hey, thanks for joining. Your piece on Tesla has been like really amazing to read also. So thank you, Gautam, and thank you, Mohit and Udit.
Yeah, thank you, Yadu. So, Dr. Ashok, you can ask your question. Dr. Ashok Sharma. I think you are on mute. Please unmute yourself and ask a question. Or Sahil. Hi, Sahil. You can ask a question.
Hi, Mohit. Hi, Gautam sir. Thanks for talking to us. I was a little late to join, but just wanted to get your thoughts on one thing, which is most companies right now in India are sort of projecting fairly good profit growths. And in fact, I'm sure all of us can find many ideas where companies are projecting at least 15-20% growth, some of them 25-30%. So my question to you is like, how would you narrow down and sort of focus on like where should we invest? Because it seems like many companies are claiming that we will grow at 25% and so forth.
Well, again, it's very subjective, but broadly, I think it's a lot depends on the underlying business model. How stable is the underlying business model? So for example, when Vikram Mehra of Saregama guides for a when he ups his guidance from 25% growth to 30% plus growth, I do believe him, because we have got such a big tailwind of mobile phone, smartphone penetration and internet penetration, and the increasing adoption of music consumption.
Gautam sir, you are not audible again. Your voice is not coming. Yeah, please go.
Believability in the management guidance depends a lot on the underlying business model, but in some cases, I mean, some companies are they just follow some questionable practices, and they are just more of bull market stories. So there are companies which are just changing their names during every bull market and coming out with outlandish guidance. So investors should be very careful not to fall into such kind of traps. We have already seen, in fact, without naming any company, there is a company which is now having a market cap of more than 15,000 crores already. And this company has basically changed name multiple times in the previous bull markets just to cater to the fads of the time. So it's context specific, situation specific, but just have an understanding of the underlying business model. And always, I think, the Indian promoter especially, I tend to discount what they're saying by a few percentage points just to build in an extra margin of safety, because they tend to get overly bullish during good times.
Thanks, sir.
Yeah, thank you, Sahil. Meet Bhai, you can go ahead.
Thanks, Mohit Bhai, for allowing me to ask the question. Hey, Gautam. Just a quick question regarding CapEx cycle. As we all know, 4 or 5 years ago, tire companies have done major CapEx, right? And since then, the auto sector got hit by headwinds, and the entire growth play got caught into value trap. So, same we have seen in the last part of the first decade of the 21st century with cement industry. So, my question is, how are you playing this capex cycle? Like, are you playing capex cycle where the business earnings comes after the completion of capex? Like, what kind of capacity utilization they will do post the completion of capex, or the proxy capex businesses where the entire sector is going for some capex and you play with proxy companies which are providing them the necessary material? So my question is, there are two ways to play the capex cycle. So what is your play? So what kind of capex cycle you are playing? So post capex cycle plays or during the capex cycle?
Both. Good question. Both, actually. So both companies which are just completing capex, as well as, so during the downturn, a lot of companies were sitting on utilized capacities, and we have got some companies in that space operating at 40-50% capacity utilization. So without even incurring any fresh capex, they'll have a much faster earnings growth. So between those two categories, companies which had expanded capacity in the past and which are sitting on low capacity utilization versus new companies which have just completed capex, the earnings per share growth will be far faster in the former case, because In case of companies which have just completed capex, initially their earnings will be hit by the incremental depreciation and the incremental interest cost. But in case of companies which have already completed capex 3-4 years ago and which are sitting on low capacity utilization, that is, I think, where the maximum alpha will be generated from this point onwards.
Sir, can you give us some example? I think you can give any example from past as well. It's not necessary that you give a current example.
Any companies, like, so a good example here would be Nosil. So I think during 2018 they had already completed, between 2018 and 19 they had already completed a large part of their capex program. So all the initial depreciation, large part of the initial depreciation, interest, capital, interest costs, capitalization, everything has been done. I think now when the given the amount of capex being incurred by the tire majors, I think Nosil should do pretty well from here. That's one example. So basically, if you look for companies which have already completed their capex few years ago, I think those will give you faster earnings per share growth from today's starting point.
Thanks a lot.
Yeah, so we will take last question from Kushal Gupta. Kushal ji, please go ahead.
Hello, am I audible?
Hi, Kushal.
Yeah, hi. Thanks, Mohit bhai, for giving me this opportunity. Hello, Gautam sir. Sir, my question to you is, like, as we see, like, in the Indian equity market, a lot of new age companies have got listed, say Zomato, Nykaa, and Zara Technologies. And earlier, like, when you used to value the other set of companies, say utility companies or FMCG companies, we were able to, like, define their cash flows for the next 2 years, 3 years. But these are now technologies companies. So in order to become a long-term investor in these set of companies, how exactly should we be looking at these set of companies? Because I think you need to have a very different perspective of getting on with investment in these new age companies.
Yes, so this was a question raised in the previous Twitter space as well. Let me just repeat that same answer. So in case of these new age companies, for most of them, the P ratio becomes basically meaningless, because in these companies, the OPEX is like the CAPEX, and therefore they'll optically be showing losses. But in these kind of companies, you want to look for whether the unit economics are very attractive. When I say unit economics, I'm referring to the contribution margin. The way to attempt value in such new age businesses is to ask the following questions. Number one, are unit economics clear and sustainable? Number two, how large is the opportunity, and will the business end up being a winner take all, or at best operate in a duopoly, or will it keep fighting off deep funded irrational competition from private equity players? Number three, how scalable is the business? Is growth a non-linear function of incremental capital, headcount, and physical touch points? Number four, how strong are the network effects in the business, and how can they be overcome by competition, if at all? Number five, how would the margins look for the business in a mature state when the cost of customer acquisition has steadily come down and the scale is high enough to drive incremental gross margin straight to the profit line? These are the questions you need to deliberate upon when you evaluate these new age technology businesses. In fact, this area of the market is a new one, and it's very important in today's digital age. That's why week 3 of my second chapter is completely dedicated. It's titled Evaluating and Valuing New Age Technology Businesses, and it basically gives a deep dive into how you arrive at the lifetime total value of each customer. For these new age businesses, the market is basically valuing all of them on a discounted cash flow model. The market is trying to understand that how recurring and sustainable is the clientele, and how sticky is the customer base. Then the market is figuring out the contribution from each customer, and then applying a multiple to each customer. Basically, the market figures out the number of customers this business can add at scale, and then arriving at the lifetime total value of each customer. And that is basically how the market is valuing such businesses. But in these businesses, rather than trying to figure out a precise value, just try to figure out and understand how is the market trying to value each of these businesses. There are certain businesses in which have no clear path to profitability. Majority of the recently listed new age businesses in India fall in this category. There are barely 1 or 2 very high quality new age tech businesses in India which fulfill all these criteria which I talked about, and those are the ones we need to focus on. Because even if we make a basket of 2, 3 or 4 such companies, very high quality new age companies, and then stick with them for the long term, we can end up making pretty good money. Because after a point of time, the growth in earnings will be exponential.
Okay, so thank you so much. So one just follow up question here, like as and when, say, suppose if you're evaluating a business like a new age business, doesn't it reminds me of the 2000 .com bubbles, wherein a lot of startups were listed during that time also, and currently, like as we are seeing, the lot of other set of startups who are achieving unicorn status, and then they are saying they'll be listed in 24 months, 36 months. So something of that sort, is it happening that way and we need to clear out the clutter? Is it like that?
Yes, it's already happened. It's already taken place in the US, right? So if you see, a majority of the technology companies stocks in USA are already down 40 to 80% in the last 6 to 8 months, because what happens is in 2020 and early part of 2021, a lot of these businesses were being valued as if they are structural growth businesses, but they were just temporary fads, or just they were just enjoying a temporary earnings boom because of COVID-19. To conclude that answer, basically, I think most of the recent IPOs in India will fall in that same category which you talked about, the 2000 tech bubble, and a lot of them will probably never come back to their listing price. But a handful of them, like for example, even after the 2000 tech bubble bust, you had companies which emerged out of that tech bubble, like Amazon and a handful of few other companies. Same thing I think will happen in India as well. Most of these companies will not make money for the shareholders, but a handful of them with the characteristics I mentioned.
So much, sir, for such a detailed response.
One key message I would like to share with all of you is just keep learning and start. If any of you have not yet started investing, I think the best time to invest was yesterday. The next best time is today. The key to compounding is time. Time is what lies in the exponent part of the compound interest function. So the more time you give your wealth and savings to compound, the better off you will be. And it's my firm belief that the opportunities in India over the next 20 years will be far greater than the opportunities of the last 20 years. And the opportunities of the last 20 years in India will be dwarfed by the opportunities of the next 20 years. So let's not miss out on this big wealth creation opportunity for ourselves and our families. And let's just adapt to the times, keep learning, and keep helping each other grow and enjoy the investing journey.
Yeah, very aptly said, Gautam sir. So, thanks for joining us as a speaker, Gautam sir, and thanks to all the listeners for joining in. And I hope we will connect with you again, because there are almost 20 plus requests as of now. There are around 20 plus messages, DMs, in which the listeners have asked their queries. So, thanks to Gautam sir for joining. Thanks to all the listeners for joining.